Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 72 on July 27th, 2019. I'm your host, Eric, and in this week's show, we will cover the trades from last week on Knight Swift Transportation, the iShares MSCI Brazil ETF, and Uber, and we discuss three new trades on Chewy Inc., Kroger, and Macy's. Now, it's always great to hear from listeners. If you have any questions about any of the trades presented here on the show, or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit our YouTube channel for the Weekly Option. Now, the U.S. equity markets ended the week slightly positive. The Dow Jones Industrial Average rose 38 points, ending the week at 27,192 points. The S&P 500 index grew 49 points to finish the week at 3,025 points. The movement in the Dow was under 1%. The S&P grew just slightly over 1% over the week. Now, the topic of the week is sponsored by the Option Studio. If you want to learn to trade options without any calculus and confusing language, visit the website to learn more about the online course. Visit www.theoptionstudio.com for more information. So the topic of the week is a concept that completely improved my option trading results in my personal account. So as a professional trader, we like complication. I mean, we love things like 3D maps of gamma groups that are color-coded. We talk about things like vol of vol and all sorts of more theoretical concepts and how they play out into our option trading. We use words like kurtosis and, we talk about all sorts of things that really can be simplified. But when it comes to being an expert and being a professional, being able to speak that language is very important, especially when you're speaking to other option traders on a trading floor. But when it comes to the personal account, you and I both have the same goal, one goal, and that's to make money. So the best advice I can give is this, and this is the topic of this week's topic of the week, is keep things simple, right? And we had something similar to this once before, but I really want to reiterate the importance of keeping things simple. And that's why I don't discuss Greeks on this show, the risk sensitivities, for those of you who have been lucky enough to learn about option trading without someone trying to teach you about the Greeks. That's also why we don't get into complex discussions about volatility. I just focus on where you make money, where you lose money, and how much you can make or lose of each trade, right? That allows you to size your trades based on the amount of risk that you are comfortable with, right? I could give you all sorts of other ratios that you can calculate to be able to determine like the level of riskiness for your portfolio. We look at relative to the return. We look at things like Sharpe ratios, and you're going to be calculating the beta of the S&P 500, and we don't have to do that here. You can size your trades based on the amount of risk that you're comfortable with. And if you know the maximum loss of each trade, it'll make sizing your trades even easier. So I found that if you focus on this alone, if you focus on how much you can make and how much you can lose, specifically how much you can lose on any given trade, it improves the odds of you making a profitable trade. So, I can't even reiterate how important this has been and how significant it's been to my own trading results and the comfort with which I can make and maneuver around trades. I've been trading options since 2001, right? I traded them on the floor of the CBOE. I traded them on the floor of the Philadelphia Stock Exchange back when that was a more active exchange. Like, I've been in the pits, and I'm telling you, as a guy who learned it the other way, the route that I'm taking with you guys as far as stripping away a lot of the complication and really just saying, where do I make money? Where do I lose money? And what do I do if I lose money? And how do I lock in my profits if I make it? My gosh, that shaves off years of just headache and complication. It would have been so much easier to just look at my position and know when and where to make money. So one of the things that I think is important is it's important for you to have a set of tools that will allow you to look at the market in a way that makes it clear. It helps you to read it much easier than if you only look at your brokerage account. So the simplest tool that I use, and I created, and I love it, it's simply a payoff graph. I use a simple Excel spreadsheet that will create all of the various payoffs of every option spread that I use. And it's really simple and it's really clean, and it makes it very visually clear. Like, I make money here, I lose money here. Oh, there's my break-even point. All of the pieces of information, the only pieces of information that matter if you're not also hedging your trades with stock, this is it. So it's pretty simple to use. And one of the things I like to do is offer it out to you guys because you are my faithful listeners. So if you'd like a copy, even if you hear this episode late, just email me and I'll send it to you. You can email me at eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've shared this with some folks in the past and they've appreciated it. And I'll likely send a video that shows you, kind of walks you through how to use it. It's super simple and it will up your option trading game no matter what strategies you're using right now. So that's it for the topic of the week. Let's dive into last week's trades. So we'll start off with the covered call. We looked at Knight-Swift Transportation, symbol KNX, Kevin Nancy X-Ray. At the time, the stock was trading for $36.98, and we looked at buying that stock and selling the August 40 call at $1.05, hoping for an 11% return in 4 weeks. Now, Knight-Swift Transportation stock ended the week 15 cents lower. It closed at $36.83 per share. The August 40 call we sold can actually be repurchased for 65 cents now. That's a 40-cent gain on the option in 1 week. So all in, the trade gained 40 cents on the option and lost 15 cents on the stock. That adds up to a 25 cents profit on the week for this trade. Now, that's obviously nowhere near the 11% we were hoping for. And it's also, I mean, it's really not even 1% of the capital that would have been deployed. But it is 25 cents or $25 in real terms before commission. So the decision of whether or not to take profit, by closing this trade is really quite personal. We're still inside of our break-even price. So break-even price on this trade, I believe, was $35.93. And we are nowhere near that right now. We're still, 90 cents away from that. So it's not a bad thing. $1.10 away from our break even. So staying in this trade, if you decided to put it on, it's not a bad thing for sure. If you decided that you wanted to take the profit and wait for another opportunity, that's not necessarily a bad thing either. So the stock right now doesn't appear to have altered its previous trend. Just appears like it pulled back a little bit, but it's done that before 2 or 3 times and then continued its move higher. So look at the stock chart, look at your own account and make the decision on whether or not you think this is a trade that you want to go ahead and close or if you want to stay in it. Now, our second trade on the week was a credit spread. We looked at the iShares MSCI Brazil ETF, symbol EWZ, Edward William Zebra. At the time, the stock was trading for $46.02 per share. we looked at selling the August 46.45 put spread, collecting 36 cents, and that leaves us with a possible maximum loss of 64 cents. Well, the MSCI Brazil ETF finished the week 58 cents lower. It closed at $45.44 on Friday. The out-of-the-money put we sold is now more like in the money. The 46 strike is in the money, and the 45 strike is still out of the money, but only by 44 cents. So the spread can actually be repurchased for 49 cents, which would lead to a loss of 13 cents per spread. Now, given that our maximum profit was 36 cents on this trade anyway, a loss of 13 cents is fairly significant. So I would close this trade and actually prepare for the next opportunity. But when I look at the stock chart looks prominently headed lower. It looks like it's gone below the previous trend. So the last 2 days of decline pushed lower than the previous boundaries for that upward trend that I was hoping would continue. So you could actually, you have a couple of options. You can obviously stay in the trade and see what happens. Hope for the best. And you guys know that hope is not a trading strategy I like to employ. I would look more seriously at closing the put side of this trade and then looking at selling a call spread against it. So you can sell the August 46.5 47 call spread for 15 cents, and that allows you to recapture the 13 cents that you lost, right? And it significantly lowers your total maximum loss on the trade if you'd like to stay in this, keep some exposure on in this ETF. So let me break it down another way. Right now, you've lost 13 cents on a spread, and this spread could actually lose another 51 cents. So by buying it in, you actually, even though you're taking that 13 cent loss, you are cutting off the possibility of losing another 51 cents. If you turn around and sell this call spread, right, you receive 15 cents, so you actually have made back your losses. So you really are flat again on this trade. But now your maximum loss is only another 35 cents because this is a 50-cent spread instead of a $1 spread. So it really does put you back at zero, and it significantly decreases the amount of money that you could possibly lose on this particular ETF. So for the month of August. So that's the way I look at trading. I like to limit risk if I can. I like to take profit if I can. And in a perfect world, I like to let my profit run as high as possible so that I can, optimize both the profit and minimize the amount of loss in the portfolio. So that's just a few thoughts for the credit spread. We'll round out our review of last week with the debit spread. Of course, we did a debit spread on Uber, symbol Uber, UBER, Uncle Brian Edward Richard. The stock ended the week at $43.18. And we bought the August 42.43 call spread for 65 cents, which leaves us with the maximum possible gain of 35 cents or 53.85% return in 4 weeks. Now, Uber stock rose $1.34 per share, ending the week at $44.52 per share. The in-the-money call spread that we looked at purchasing is actually even more in the money now. So in fact, the spread is $1.52 in the money at this point. So if you tried to sell it on the bid, you would only get 50 cents for it. But if you tried to buy more of it, it would cost you 80 cents. So they have a really wide bid-ask spread in it. This spread will expire. We know if prices stay higher than $43 per share, this trade expires for being worth $1, and we will collect our 53% return on this thing. This trade has, of course, 3 more weeks left. So if you did decide to execute on this trade, definitely keep an eye on it because you don't want to let that stock head back lower than $43 per share. If it comes anywhere near it, you go ahead and exit the trade. You can do that by exercising both and exiting the trade. So it really at this point is money. It's money sitting there, and you want to make sure that you are able to capture as much of it as you possibly can. So that's it for this week's or last week's trade review, let's go ahead and dive into the trades for this upcoming week. And of course, we only have a couple more weeks where we're going to be looking at August options. In 2 weeks, we'll be looking more closely at September options. So even as an adult, summer tends to go by so fast. And so thinking about September and trading September options actually makes me a little bit sad, because that's a reminder that that summer is in fact coming to a close. So hope you guys love summer too. It's my favorite season. I have a birthday soon, and so that probably is part of the reason why I've always loved summer, because I always got to have pool parties for my birthday parties as a kid. None of these fancy parties that people do these days where they spend, $10,000-$15,000 on a kid's party. We just had a homemade cake, maybe a store-bought cake, but I was happier when it was homemade. And, invited my friends over, and we all went swimming in our pool. So it was a blast. So that's it. Consider this my ode to summer, because I love summer. I also love winter. I love skiing. But if I could ski and still have it be 90 degrees outside or 85 degrees, I'd be pretty happy. Let's dive into the trade ideas. That's enough for me rambling. We're going to start off as usual with the covered call. And this week I'm looking at an IPO. I've enjoyed some of the IPOs we've looked at. I don't know if you guys followed weeks ago, or a couple of months ago actually. We looked at Beyond Meat. And Beyond Meat at the time was trading for around $63 per share. It's up about $100 per share since then. I shouldn't say that. I haven't looked at it recently, but I know at one point it was trading well over that $63. It was trading over $100 a share, which just blew my mind, because if you're trading a call spread and you have a stock run up like that, it really just kind of hurts. You can always just re-enter the stock, right? Buy the stock again, or go ahead and buy in the call option that you sold. But you do that, you lock in 10%, and most of the time that 10% is going to be significantly better than you would have done otherwise on that stock in the market. But you see these one-offs like these IPOs that have just gone through the roof lately. So this one, we'll see what happens. I'm looking at a covered call on Chewy Inc., symbol CHWY, Charles Harry William Yellow. Stock ended the week at $32.45 per share. We're looking at buying that stock and selling the August 35 call at 75 cents, creating a maximum return of 10% in 3 weeks. Now you enter this trade by buying Chewy stock for $32.45 and then selling the August 35 call at 75 cents. This trade makes the most money if stock prices finish above $35 per share, and the break-even price is $31.70 per share. And the reason why this, if you look at the stock chart, the reason why Chewy stock has come off a little bit is because there's a hedge fund manager that's comparing Chewy Inc. to Pets.com back during the dot-com bubble. And that didn't fare so well initially, but Chewy, I believe, has a different model. They are a legitimate e-commerce brand, and the other analysts and the board are certainly saying, hey, this is stronger. So we'll see if they can push the stock up. If, of course, it goes higher than 35, you have a few decisions to make with regards to whether you decide to buy in the call that you sold, or just let it all expire and be happy with 10% in 3 weeks. So that would be, those are optimal, those are good choices, good problems to have. Now, our second trade on the week is a credit spread on Kroger. We haven't looked at Kroger in a while, symbol KR, Kevin Richard. The stock ended the week at $21.48, and I'm looking at just selling the August 21.5 22 call spread at 19 cents. That yields a possible maximum loss of 31 cents per spread. Now, you enter this trade by selling the August 21.5 call at 44 cents and buying the August 22 call for 25 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices finish below $21.50 per share. The break-even price for this trade is $21.69. And then our final trade on the week is a debit spread on Macy's, another stock that I haven't looked at for a couple months. And I like this stock because the options tend to have some opportunity that's worthwhile. So for those of you who are looking for a couple of equities that you could follow to really become a specialist, Macy's isn't a bad one. Macy's has good pricing. I think the specialists who price this do a good job. And so I like the opportunities that are present. And it's just a matter really of getting used to the stock and deciding if it's one that you can trade or not. But Macy's symbol is M as in Mary. The stock ended the week at $22.87 per share. And we're looking at buying the August 22 half call spread for 32 cents, which yields a maximum gain of 18 cents, maximum possible gain of 18 cents per spread, which would be the equivalent of 56.25% return in 3 weeks. Now, you enter this trade by buying the August 22 call for $1.63 and selling the August 22 half call at $1.31. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices stay above $22.50 per share. The break-even price on this trade is $22.32. So that's it for our 3 trades for the week and our trade review. Thank you guys so much for listening to the show. And you know what? Please share it with a friend. If you have a friend that is talking about option trading or learning to trade options, this is a great way to do it. You get to hear the trade ideas, and trade review the next week. I hope you guys are enjoying the show. And thank you guys so much for the people who email me. I do love it. It's fantastic, and I try to keep up on all the emails. So thanks so much for sending me a message. And of course, email me if you like a copy of that option payoff spreadsheet that I actually use in my own trades. So if you email me, I'll go ahead and send that over. Email, of course, is eric@theweeklyoption.com. Have a great week and happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.